We all know that feeling, right? Payday. That great feeling when the hard work pays off. But have you ever really stopped to think about what your investments are actually paying you? I mean, beyond just hoping the price goes up. Today, we're doing a deep dive into exactly that. We're pulling some really key insights from Charles B. Carlson's book, The Little Book of Big Dividends. Now, Carlson, he's a Wall Street Journal veteran, and his book offers some really common sense truths, stuff designed to help you actually take control of your financial future.
Yeah, exactly. And our mission today really is to unpack what Carlson's saying. We want to look at how dividends aren't just some, little bonus on the side. They're actually a powerful engine for building wealth long term, often overlooked, frankly. And maybe most importantly, we'll get into how you can spot those truly safe dividend opportunities. Because, well, there's a lot of noise out there.
Okay, let's jump right in.
Yeah.
Carlson's core idea. It seems to be that while everyone's watching stock prices, capital gains, dividends are actually a huge piece of the total return puzzle.
That's spot on. It's kind of amazing, actually. Most investors, they chase the headlines, right? Focused only on that stock price going up. But Carlson digs up this, pretty staggering fact. Roughly 40%, 0% of the stock market's long-run total return. It comes from dividends.
Wow, 40%.
Yeah, it's not just a little extra. It's this quiet, consistent engine driving wealth. And think about it, unlike stock prices that can bounce all over the place, dividends are often paid out pretty reliably, even when the market's having a tough time. He gives this great example, Johnson & Johnson. Imagine putting $5,000 in way back when. If you just reinvested those dividends consistently, that initial $5,000 could have grown to something like $346,000.
$346,000.
Yeah.
From five. Okay, that's serious validation, like you said. That 40% figure, it really shifts how you should look at investing, doesn't it?
It really does.
But, okay, hold on. Before everyone listening rushes out and just buys stocks with the highest dividend yield, Carlson throws up a big caution flag here, right?
Oh, absolutely. This is crucial. It's a really common trap. People see a huge dividend yield, the annual dividend payment compared to the stock price, and they think, wow, free money.
Right. Sounds amazing, but risky.
Often, yes. Very risky. Carlson tells this cautionary tale comparing Thornburg Mortgage, which at one point had this, eye-popping 20% plus yield.
20%.
Yeah, but then it went bankrupt. Compare that to, say, FPL Group, which had a more modest yield, around 3%. But they reliably increased their dividend over time. Much safer, much more sustainable. Carlson puts it bluntly, dividend yield is a pretty good proxy for investment risk.
A proxy for risk. So a super high yield isn't necessarily a good sign. It could be a warning.
Exactly. He gives some rules of thumb, some red flags to watch for. Like if a stock's yield is maybe 3 percentage points or more above its competitors, or maybe 4 or 5 times the average yield of the S&P 500, that's when you need to be really careful. Dig deeper. And the best tool for that digging, according to Carlson, it's the payout ratio.
The payout ratio. Remind us what that is.
Sure. It's simply the percentage of a company's earnings, its profits, that it pays out as dividends. Carlson's logic is simple. No profits, no dividends. If a company isn't earning enough money, or if it's paying out too much of its earnings, that dividend is probably not safe. It could get cut.
Okay, that makes sense. Look at the payout ratio, not just the yield. But this all sounds powerful, but maybe complicated or expensive to get started.
Yeah.
What if you don't have a ton of cash or a broker on speed dial?
Yeah, great question. And Carlson tackles this head on. Accessibility is key here. He talks a lot about direct purchase plans, or DRIPS.
DRPs. Okay.
These plans let you buy stock directly from the company itself, often bypassing brokers or at least big commissions. And the minimums can be surprisingly low, sometimes $250, maybe even $100 to get started in some plans.
So much more accessible than people might think.
Definitely. And some companies even offer discounts. He mentions Aqua America giving a 5% discount on shares bought with reinvested dividends through their plan. Which brings us to the reinvestment part. If you really want to build wealth over the long haul, Carlson stresses this. Cashing those dividend checks is not the way to go.
You gotta reinvest them.
You gotta reinvest them. That's how you unleash the power of compounding. You know what Einstein supposedly called the eighth wonder of the world.
Right, compounding, where your returns start earning their own returns.
Exactly. That steady drip, drip, drip of reinvested dividends eventually turns into a real stream, then maybe a river, of growing wealth over time. Plus, dividends that grow over time are a fantastic way to fight inflation. Your income stream keeps pace or even beats rising prices. And of course, don't forget diversification. Spreading your money around, maybe including some international stocks through ADRs, those are American depository receipts.
Right, lets you buy foreign stocks easily.
Yeah. Diversification is still like the only free lunch in investing when it comes to managing risk.
Okay, so pulling this all together, as someone listening thinks about their own investments, why should they really care about building a portfolio focused on these big, safe dividends, as Carlson calls them? How does this change things?
Well, think about it this way. Instead of always chasing the next hot stock, the next big thing, or getting lured in by those super high yields that might just be too good to be true, what if you shifted your focus? What if you concentrated on patiently building a collection of companies that literally pay you to own them year after year, and not just pay you, but aim to increase those payments over time so your income stream grows? Your money starts working much harder for you even when you're sleeping or on vacation. It's like building your own little financial ecosystem, constantly working, constantly generating those paydays for you long into the future. That's the real power here.